Hello, everyone. Coming to you today to talk about a few things on a mountain of alpha that have changed and a few topics about the market. We're getting some volatility now, and how I kind of see, how do I utilize volatility in the VIX and how I know when to place trades, when not to place trades. I think it's very helpful. It's helped me stay out of the market and avoid a lot of these drawdowns, which is incredibly important to P&L. So we got some volatility in the market. And this was coinciding with a real strong gamma pin that was sitting at 7,600. And so gamma must have kicked in here at some point. And there's also a lot of semiconductor names and AI trades and all sorts of stuff that have just been on a tear. And so they're probably getting some profit taking in a lot of these names, right? There's probably just some profit taking as well. But the way I look at it is the first thing I observe is the VIX. And the VIX is the expected vol for the S&P 500 over the next 30 days. And now that doesn't always correlate to individual names, of course, but it's helped me very well, and I'll explain. So I'm going to go to the VIX right now. This will be today. And I always look at the gamma pins. And the gamma pins, you could see when I talk about pins when I say spread, what I'm talking about is you see these large put and large call. These are the nets, so it's subtracting the absolute value of calls and puts, and here it's puts and here it's calls, and it's on the same expiration, and those are the largest call and largest put. They're actually nets. So I think this metric here, like largest call, is actually kind of wrong. It's actually the largest net. As a side note, before I track, in the historical, the metric is actually, it's called a peak call dominant and peak put dominant. That's what it's actually called. So I just want to let you know that those are the same thing. These two are the same thing. Okay, so what I do is, when volatility is really low, well, let me rephrase this. I look for the gamma spread. And the gamma spread here is the 1825 spread. There's also this faint one here, this 1835 spread, right? So 35 looks like some area that if we really did get a really big gamma squeeze in vol, so that'd be vol of vol, then 35 would be kind of a zone in which you would start looking to add to positions. Okay, so when you're down here, you're very cautious about adding to positions, especially if the spread is overhead. If the spread is lower, you're fine. It doesn't matter. Stay the course. And when you're up here, you're looking to add to positions. So let me give you an example. Let me go back in time. So I'm just hitting B on the keyboard, and it goes back in time. I hit V, it goes back to the OPEX of the last month. So 417 was OPEX. I hit V again, 320 was OPEX, right? So it jumps to OPEX for the month if you hit V. And then if you hit N, it goes forward to the next OPEX. But if N is the next day. M is the OPEX, my bad. So I'm hitting N to go forward. And so here, we're on 330. And 330 is, we're at the top of the spread. There is a faint 35 here, right? This 2035. But there's also this spread here, right? The 819.30. So your add to positions is in this area. Now, not everything you add to is going to actually rally. That's art in itself, right? There is kind of a probability to this. It's not nothing in trading is certain, right? But it does help eliminate a lot of wrong possibilities. It just increases odds. So I'll give you an example of one that doesn't work, which is what I bought. It's something I did. Okay, so I got SPSC. So I saw this, and I was like, oh, this is a really strong spread, and I'm going to trade that spread because volatility is going to collapse. So I put my trade on, right? I got this 55.80 spread for September. Or sorry, July, not September. July. And that's what I have here. Yeah. Here's the July. Well, 50, I did a 55.80, but okay. So, oh yeah, 80, my bad. Jeez, what's going on here? Okay, so this was peak vol. I'm going to show you. So we know that vol collapsed and went all the way down here, right into May. And if you go to SPSC and I forward all the way to today, it's just hovered around that put, that largest put dominant strike, right? So it hasn't really done much. And I think I contribute this to it's very thinly traded. You go to the volume, there's just no volume. And I think that's part of the problem. So maybe I bought something that just didn't have a lot of activity, right? So I'll avoid that in the future. So if we look at, but I still got to July. We'll see if volatility comes down and we get a rally. Maybe I can get out, maybe a little loss or something, but I'm not holding my breath on this one. So let's talk about ones that maybe did. Now, obviously this is hindsight, but I'm trying to show you what I mean by this. Let me go back to 330. Okay, this is 330. This is peak vol. And let's go to ALAB, for example. Oh, it's already in there. Oh, I think I'm going to make a... Yeah, I'm going to make an improvement there. So I typed ALAB, but it's already in my ticker list, but it didn't load it. So I think I'm going to make an improvement there. I'll do that in a second. Okay, so here, ALAB doesn't really have any definitive spread. I do see this long-term call, net dominant call here. Wow, that's interesting. I wish I would have saw that. But I don't see a spread that's like very obvious like a Reddit. Like I look at a Reddit, I can see this spread, this 115, 220. So ALAB is not exactly the spread strategy that I've been trading. Now I did develop another strategy that tries to find high convexity. So you're trading the right side of the distribution. Now, on this particular trade, sorry, I was thinking about the screener. I was going to run this. I'm going to run the screener on the high convexity in this video and see if ALAB pops up. Okay, so this trade, I'm going to forward to the end date and see where we are. Well, 330 down here was the low. That was peak VIX, and we rallied to 360. So you can see, like, if you get the right trade, if you can find the right trade in peak vol, you can make a lot of money with high convexity, right tail-based movements, right? And you could see that when volatility was below the pin and then volatility actually came into the market, you started getting some downward price movements, right? So it's just ebb and flowing. Now, EMR is what I bought. I bought an EMR, and the spread was pretty dominant. It was a 130, 180, if I recall. Let's see. 155. I think there was like a 160. Anyway, 155. You could see that one here, right? It's this 130, 155 in September. So that's what I was trading. Now here's 330 right here. And I placed some trades. And when volatility really collapsed on this 4.8 right here, this 4.8 date, that's when it really collapsed. I got a really nice movement. And really nice trade. Then I shorted half. I shorted 5 of May, and I bought it back at 16 cents. And then it rolled over, which was fine. I collected my credit. And then it bounced on the put pin. Here, you can see it bounced on the put pin, and then it sold off on the call pin. See that? But I still see this long-term spread sitting there. I don't see any other obvious long-term things. But you can see that through June 18th, so that's the OPEX for June 18th, we're probably going to go back down to 130, right? And then hopefully for September, we rally back up to 155, and then I can sell. I can take profit in that area. But I should have sold credits here. I just didn't. I saw the call pin there, and I was just too busy. I just didn't do it. Okay, NTNX. NTNX. NTNX didn't move right away. It took a few more days, if I recall. Yeah, see, 410. So this actually took a week or two for it to really come around to start moving. And I do see that lag effect from time to time. But this was up like 8 weeks in a row or something. Or 7, something like that. So it was 1, 2, 3, 4, 5, 6, 7 weeks in a row. 8 if you don't include the selling on the close there. So that was a nice little rally. I mean, it's no A-lab, but that spread I put on. This one didn't react right away. It took until 410 for it to react, but it was this. Well, it wasn't as strong here, but it was the 40.75. Let me see. Oh, you know what? I was on gamma. So, okay, there's a couple nuances to this. Some of my trades were based on gamma pins. Some of my trades were based on delta pins. But I did a bunch of back testing, and the delta spreads tend to work better for right-tailed distributions, so more convexity type trades. Gamma seems to be more consistent. So I can't remember if it was a gamma spread or a delta spread. I just can't remember. But I was trading a spread. Some spread showed up, and that's what I was trading. It was I bought it before this move down, but I know that there is this large put pin here at 40. Anyway, so we got a rally, and it's all call delta, which is really nice. That tends to go against you if volatility comes in, but it looks like it's holding up, so that's pretty good. Anyway, when it rallied, I shorted to protect earnings results. So I sold 6 for June at 229. And if volatility really comes in and starts going up to that 25 pin, and we get a big downward movement, I'm going to collect my credit, my 6 credits I sold for 229. But I have this thing out till October, so I'm just going to sit on it. I'm just going to wait. I already have a hedge. If the price just maintains where it is through June, then I'll just close this 6 with the 6 long, right? And then I'll just be left with 9 long at 50 for October. That's fine. That's okay. I'll still make money. I'm still making money. It's up like 160% or something. EMR was up like 40%. SBSE is down like 70%. So I need something to happen here pretty shortly here, because I only have about 1.5 months or something like that, right? Okay, so what I'm trying to say, if I just go back here, is you look at VIX, you look at the gamma pins, and just be cautious of where the pins are. You could see there's this faint one here, 1835. And so if the 25 goes away and resolves after June, well, it's almost like a coin flip whether you're going to 35 or back down to 18, right? And what you're really trying to find is when volatility is up in this area and the pins are still maintained and the spread is still there, you're trying to find long ideas to go long, because high volatility environments don't last, right? Okay, and so what I do, okay, before I go, I do want to check that A-lab. And so here's some changes to a Mountain of Alpha. So I've broken down the site into metrics, and there's about 340 metrics or something like that. I can't remember the total. There's hundreds of them. And the screener has now been replaced to where you can use those metrics. So I go here, and look, there's hundreds of different metrics that you can use. There's a lot of universal-based metrics, so these are percentiles. So on this day, total call open interest universe percentile. So I can say like, oh, what's in the top 10% on this day, right? And these are the top 10% total call open interest right? But what I wanted to do is I wanted to run this convexity outlier and see if ALAB, I think the market cap would be there, if ALAB would show up at all. No, it doesn't. But I wonder if these other ones turned out really well. I'm not really sure. So there's Carvana. That's interesting. Okay, so here what I do is this is the screener for this date, and I just forward to today. And I just kind of eyeball where that March 30th was, and I see the kind of, if this convexity style approach, where was this? March 30th, so that's there. Western Digital, March 30th to here, so Western Digital did really nice for that convexity trade. STX, March 30th, so STX, you see Seagate worked. So you can see when volatility compresses, March 30th here, so Sienna did okay. You would have to have sold before that volatility came in with that spread that I showed you in the VIX. TER, it did okay. It was a bit choppy though, a bit volatile. March 30th, okay. Coherent did okay. Rocket Lab, March 30th was here. That did really well. 50 to 150. That's a 200% gain in the equity. Symbiotic, that did not work. That, it initially went up and it rotated. So that one didn't work, right? So that's what I do. Like I'll go back in the screener and kind of look at things and judge things and try to find those ideas. Now, another thing is that if I go back, oops, March 30th, we could probably, so I've taken my screeners that I use. I have a bunch of screeners, and I put them as presets. And so this preset is for a bullish delta spread, and these are the candidates I run for delta spreads. Now you got to make sure you're on delta, right? So you could see like this is a very large delta gap, and so I don't really trade those. What I'm typically trying to find is close. No, how do I do this again? There's a way to do this on the site. I forgot how to do it. I don't think I can re-add. Yeah, I can't re-add the metric and do another comparison. That's a bit unfortunate. I might have to fix that. There's a way to do it where, let me see if there's a spread. Strike's not there. Can I do that here? Ah, that's where you do it, yeah. So you can't add the same metric twice, which I think I want to allow you to do. But here, like, I would want the close to be below the put side, right? That's what I would want. But here, like, if you go back in time and look for these spreads, there's a spread in Reddit for here and here. I was waiting for this trade. Go back and watch videos. I was waiting for the price to come down to like 100 so I can get a good deal. And that's where Reddit kind of bottomed right there. But I don't think there was any specific type of spreads that worked. I mean, that's too tiny. The spreads have to have a minimum of 300% gain. I wouldn't trade that. Wouldn't trade that. Too thin, too thin, too thin. Wouldn't trade that. Wouldn't trade that. So spread trades. So these spread trades don't come up very often. They're pretty rare. It's about one a month, but they have an incredibly high hit rate if you find one that correlates with elevated volatility. And so I'm going to go today and I'm going to show you some ideas that I've been just watching and watching and watching and watching and watching. Okay, so Cell is one. Celsius, it's a beverage. They own 20% of the beverage market. So there's this delta spread, this 30-55 spread, and we're at peak. We're not at peak volatility yet, right? We're approaching the, okay, VIX is already in here. VIX, and then gamma. You can see it's below, and now we're kind of like trading within this spread. So we got some, we still have upward movement in vol, at least to 25. And then if we survive the VIX OPEX, which is on a Wednesday, right, instead of a Friday, that's 617, then it's kind of a coin flip whether we go back down or we start testing these 35 call pins, gamma call pins. You could see this spread here is a 20-35, right? So if we really want to add to this position, I mean, we just want to pray for a bloodbath in the market up to 35. That's what we want to pray for, because that is going to give us tremendous amount of opportunity. Maybe we're down here at 25 or something, to where then we can put on this end of the year spread trade at 30.55. And so when volatility eventually comes off and all of the puts start being reduced in implied volatility, because as the price moves higher, the implied volatility goes down on those puts. Well, doesn't always happen. I understand that. But this is the idea, is that people are buying the downside put protection, which pushes prices up, which intentionally increases the implied volatility of that contract. So when implied volatility falls, the dealers have to buy back, right? And so, one sec, sorry, I'm coughing. Sorry about that. And so when we're down here and we have low volatility, we want to see that rally and hit this top pin. So we have this 30.55. And so what I can do, I go to the chain, and this is, I also put dates on here so you can see things easier. And it'd be this trade. It's a 30.55. And I look at it, it's a 474% spread, bull call spread, which is great. You're looking for a minimum of 300% on the trade, but that is going to widen as volatility increases and the price goes lower. So this might go up to 500, 600, something like that. And those are the trades you look for in these spread style trades. So let's see what else we got. Okay, so Toast is one, but it's sitting down here at 20. So there's this 20.35. So if volatility comes in, we're probably going to get a destruction downwards, because we're already seeing it like show some signs that it's doing that. And it may take until August for things to resolve. You can see there's a lot of these strong puts at 20, and there's this 20 here. So it looks like 20 is an area that you would probably put on that trade there. It's to the end of the year. A lot of these ones are to the end of the year. Trip had this 820, but it's a pretty thinly traded equity, so I'm probably just going to stay away from that one. Wix was another one, but it's longer term. Yeah, it's this one. It's a 70.120. You could see a new spread just showed up, a 62.50.45, and it's sold off there, and it's kind of pushing down to this 45. Now, there is another metric, a part of this spread trade. If the price is below the put, that's a good trigger. And then this particular put, it'd be the call side. So it's 86.6%, and you can see like the implied volatility is increasing. 86.6%, and I forgot how to do the metric here, but you could calculate the sigma distance of the closing price to this particular strike's implied volatility. It's called the option time horizon because this volatility is quoted on a yearly basis, but the time horizon is not a year. So you have to compensate by converting the expected implied volatility of the time horizon of the option. But the sigma you get out of that has to be below 0.5, which means that as price gets lower and lower and lower, this trade does not become feasible. They just don't work. I've done back testing on that. So you just have to make sure that your price where you're buying this, the spread trade isn't 170, 230, right? It's just way too far away for you to make any money. So there's that it's called a sigma gate. And I can describe that in the future, but let me go back. It's probably a delta trade. Yeah, all these are delta trades. There it is. See? I was on gamma. So that's another spread trade. And I'm not sure what that's showing up now. It's a 7120. Let's do that. Chain, January 7120. You could see it. Look, you see it's there. The 7120. See that? That's the spread. 681%. So these are the types of trades I have on my watch list. And if volatility comes up into that 25, I may think about putting the trade on. So there was the bottom of Reddit we talked about. It rallied, decent rally, but here's the spread, 115, 220. And it's been there forever. And the price has gone up to it, below it, above it, and we almost went below it. And you can see like the price is trading within that spread channel, you see? And look how much option activity there is. That's what you want. You want this really strong signal with a lot of option activity. And it's very rare to find this, and Reddit is the example. Okay, so this one is a delta spread. I don't quite see it in oh no, it's not. Sorry. This was a convexity trade, and I've been monitoring it. So some of these are not spread trades, they're convexity trades. And then what I like to do is I like to look at the gamma of the S&P 500 and see where the gamma levels sit. And it's not entirely obvious. There's this 7095, 7600. It's not entirely obvious right now. We just got a lot of volatility. Let me go back a few days. Yeah, it hasn't been really obvious where the spreads are in the S&P 500. That's typical when you start getting really strong rallies. You don't see these spreads show up. Yeah. Okay, maybe the NASDAQ had some clearer base spreads. Let's see. So there's this 29,200, 27,500 spread, and that's for June. That's June OPEX, which, remember, VIX is June 17th. It's the day before. And so if you go to the VIX, it kind of correlates, right? So you have a spread to the downside, and VIX has a spread to the upside. And you can see that's June 17th, you see? Now, it's probably a bit wonky because you have June 10th and then you have June 17th. So you only have 2 contracts in between that date. But NASDAQ has 0 DTEs and all sorts of junk in there. So you get more bars. You get more bars in between, right? So you just got to hover over the date and make sure you know what date it's being identified on. There is also a slight, spread there down to 2,700 for July, but then the put moves up. So that this looks like a push down and then a resumption of the trend up to 32,000. You see this 28,000, 32,000. So volatility and choppiness in this range, and then throughout the end of the year into December, you expect some rally into August. So you can kind of judge these things, and then when you look at things like trades you want to put on, sell, I could see like, oh, August will be, all the way through August will be, well, up to August will be choppy, but this is the turnaround expected in the market so far. It changes every day, of course, but you're just trying to understand. And if you get downward movements down here and you expect a big rally upwards, well, it's going to blow through this spread. It's going to blow through this 300 because as the price moves up, they have to sell this $30 strike, the dealers. And so they're hedging it to the downside. And you can see already it's sold and sold at this pin here. It's, well, even over here, it's sold down, sold down, sold down, sold down. And we expect that consolidation down here. It goes down, it goes up, it goes down, it goes up, it goes down, and then it eventually breaks out and rallies back up. As long as this spread is maintained and doesn't go away, it's still a trade. And I could see that it was put on here, 402. I go here, this was put on 402. You see that? So there's someone has a very large spread put on this trade. Okay? So I can see it hasn't moved and it hasn't moved. That's good. And that's what you kind of check. So that's the spread style trading. Okay, so all I'm doing is waiting. I haven't put in on any more trades. I haven't found any trades, so I don't put the trades on. And that's one of the hardest things, I think, to learn as a trader is like everyone has to trade every frickin' move, and they have to be a part of every single rally, and they get FOMO, and who cares? You have unlimited opportunity. It's open every day, and when everyone shits the bed, you'll have tremendous opportunity. And look at that. Look, sell actually went up and everything else went down. That's when volatility went higher. That's probably a good sign, right? So those are some metrics to, keep aware of. And then watch the volumes. Volume is a good metric to see expectations of potential future spreads or trading. And so I could see like there's this 25-35 before earnings, and there's this really strong 25, right? And then if I go back to the delta and open interest, right? Because this is calculating from open interest. I see there's this strong 25 bar down here. And okay, maybe 25 is kind of the area we want to think about putting the trade on. But that's going to have to coincide with much higher VIX, hopefully above 25, right? Maybe, give it some time. See how VIX reacts to 25, and you'll have plenty of time to put this trade on, even if you're at 25 and it rallies back up to 27.50 or whatever, even 30, right? So volume is a good metric to keep track of when you're kind of looking at the current trades you're in to see how the option activity is placing forward bets. So I can kind of see like this spread here is showing up. There's this larger 160 call. Someone bought a 135 call. Okay, SPSC might come back down to this 50, right? But this is volume though. It doesn't necessarily mean that it translates into open interest, because I could buy the contract and then I can sell the contract, and then that's showing up as 2 volume, right? But nothing happened. It's a wash. So, but someone has to buy it, someone has to sell it, and someone is going to hold it overnight. Like, that's just how things work. So anyway, so I like looking at volume and going through volume to see like, oh, I could see like 22 is probably the target. Who knows, right? It can re-rally back to 26 because tomorrow someone can buy a shitload of calls or something, right? And then I can kind of judge like very faintly these spreads. And you could do that by, if you go to expiration and take off relative, then it helps you pull out where those spreads could potentially be. So here, the 21.35, and that's for December, right? And then I go back to Delta, and, well, I can't remember. What was the largest one here? Okay, that's a bad one. Toast is sell. Okay, sell is this 30.55, right? And I can kind of judge here that, okay, it may be kind of flat through August. After August, we could potentially hit this 40. We have an inverted spread here, which is actually really good news, because the inverted spread is as price rises, they have to buy and hedge this 35, and then they have to sell this 50, which is like they have to cover. So it's a double buying, basically. So I can see that maybe a lot of these moves will come in December to help accelerate towards this 55. But I could see there's some downward pressure here, with like 19 being the lowest, right? But this changes. It changes all the time, right? And you just got to monitor it and make sure that you're seeing stabilization in the spreads, because that's the most indicative of what's going on. So if I look here, I can see that this 25 is very strong, with really strong support at 22.50. And so there's this 22.50 for September, and that's earnings, see? So you can get a judge of where the spreads are by using this. Let's see. Okay, so historical. Excuse me, got a cough again. Okay. So what is historical? Historical changed, which I'm going to add back in some of the charts I had on the historical, because people want to see like per expiration and things like that. But what historical allows you to do, it allows you to chart all of those metrics you want on the chart. And so here I have net delta percentage of book. I have net delta percentage of float. This one is tilt. That's basically change in delta, net delta. And then I have my peak put and peak call. That's what I've been talking about. That's the spreads. So I can see in NTNX that all we really have is a peak call and a peak put sitting at 40. See that? And so that's support, basically. And I could just tab through a few of these and look at them. So here I can see my 130, 155, and you could see that there's the call spread here, right there. That's the call spread, and it rotated over. So I can see I got some support here, and it kind of disappears after July, right? Okay. And what I can do is I can turn on the tilt and the net delta like this. And obviously they're different metrics, so you got to like, you know, net delta percentage of float is going to be much smaller than the book tilt. So you get squashed. And I can't add extra axes because the TradingView charts don't really do that. And so here's what I wanted to show you is that typically what I find is that high convexity trades coincide. Now this is just a theory. I'd have to backtest. They coincide with elevated VIX above the call spread pin, and net delta percentage of float is negative, but not incredibly negative. And then you get a flip and volatility compresses, and that's your trade. So if you look here, this is the zero. You see the zero on the left here? So on the 330, net delta as a percentage of float was negative 1.94. The book tilted negative. If I go back, you see like, you can see all the extreme tilts down here were all the bottoms, right? And so this went negative. And when volatility compressed, you had a flip in net delta. See? Flip. You had a flip in April 2nd. And then ever since then, it's just been an incredible ride all the way up. right? And now it's sitting at 6.68% of float and 82% of net book, right? That's a pretty big metric. And we're at kind of the upper end, right? So what I like to find with the high convexity trades is to come on this and, oh, also, here, look. Here. So actually this, does this change? Let me go back to 330. I'm not really sure how this is going to display. Well, it did it a little bit. Oh, was that the April 2nd? Yes, okay. Yeah, so it does plot it correctly. So look here. We were negative. We just flipped, but look at the spread. It's an inverted spread. Because the puts are generally below the call, right? It's inverted. And so this is what I'm talking about inversion, is that you're going to have dealers hedge these calls by buying, and this put they're going to have to short cover. So it's a double-edged sword. But you could see this spread here that is out until June 18th, which is this month's OPEX. And if I just go forward a month, now this is, right, look, it plowed directly through that spread. Look at that. And now the spread's higher. See that? So now we have and it's inverted again. It's a 210, 280 spread. Go next day. I'm going to get rid of this metric here. 280 spread. And sometimes you got to be a little bit careful with these. Oops, I just jumped all the way to today. My bad. Is this what it was? When was the date? Was it this date? 200, 280 spread? Yeah, it was this date here. These two dates here. You can see the calls moved up though. But what I was saying is you have to be careful with those spreads because these are peak call dominant, especially with delta on equities that have very dispersed options like Apple or something like a large cap, is that you don't get very stable large strikes for these things because the options are so dispersed. And if I just go in here and go back to where we can really highlight things, you could see the dispersion of how much options are currently being traded in Apple. And so you won't have a single trade or a single position dominate. And so you're not going to find spreads. So these trades have to have some type of convexity type outliers. And I was back testing this. This one is a high convexity trade. It tells you here, right, what you need to search for. It's right tail distribution trades. They only work 15% of the time because you're buying a 15 delta, right? And you're trading the 120-day DTE with a minimum of 30 days, but you avoid these trades when volatility is under 20. That's like one of the metrics that helps gate the returns. So I'm trying to find some high convexity trades that can help identify large caps or things that won't reveal to you these large spreads. For example, if I do this and I search my spread trades, it's market cap over $1 billion, so it's the whole universe. But what you'll find is that the reason that you find these spreads like this is because there's not an incredibly large amount of dispersion, you see? There's just not a lot of trading going on, so it's easy to identify where the spread is. There's not a lot, but you could see the spread. Twillo's a different story. Reddit is an outlier. You're trying to find those outliers, that's what I'm trying to say. But more often than not, you're not going to find large caps in this trade. You're just not going to find them. You're just going to find like 5 billion, 4 billion. You see, like you're not getting a 3 billion. It's not going to show you a 400 billion market cap, right? Look, 3 billion. So 3 billion. And so and the reason the spreads show up is because there's just not a large dispersion of option trading, and so they show up. That's what I'm trying to say. But you are trying to find those outliers like Reddit where you really do get the dispersion and you really get someone in there sitting on a really strong position. Those are the best ones to trade that I found with this strategy. And those ones tend to be long and more stable and highly profitable. The return on that was 80% if you add the sigma gating and the VIX gating, but it reduces your trades to about 1 a month or even less. So you're waiting a lot. This is a trade where you're just waiting and waiting and waiting and waiting, but this strategy actually scales with the portfolio, so you can just constantly add 5% to every trade, right? You're not have to be gated by anything. On this one, on the convexity, what worked was a fixed trade strategy. So if you had like $25,000, the max you would buy on this trade would be $500, but it have to be forever. You're always allocating $500. So if you made $350,000, you're still allocating $500. Why? Because you have so the delta is just the cumulative sum of distributions. So if you just have a distribution graph like this, and this is the cumulative sum of distributions, right? Well, the 15 delta is sitting on the right tail. This is called the right tail over here. This is the right tail. And this is the left tail over here. Oops, over here. And so you're buying like the 15 deltas over here, but the probability is 15% because that's the cumulative, right? That's what they say. Which is probably more like over here, right? Not really the 3 standard deviation, but it's over here, right? You're on this side of the equation. So the probability that you're going to get hit is really low. But if you do get hit, you're really going to get hit. Like you're going to make a 900% return or something stupid. So this tries to trade the convexity of the trade, the right side tail distribution. The spread trades, because you're shorting something, it helps reduce the position size, but you have a fixed return. And those ones are larger hit radii, but you don't really get that. You cut off upside potential here and you cut downside potential. So you're really trying to do something like this, where you're trading in here in this distribution. So, but you're cutting off a lot of like downside risk because you're doing this short to help alleviate some of the entry cost, the premium to what you're trading. So it does cap upside, but it does increase probability because you're including more of the distribution in your return profile. Okay, so make sure that if you're doing this convexity outlier, that you're waiting for VIX to be incredibly elevated, like here, up in here. Oops, my bad. You're waiting for VIX to be up here, up here, up here, up here. Then you're running the convexity outlier. But even then, you have to be careful with what you're buying. You have to buy things that are market theme-based trades. So right now it's in AI, and maybe next it's going to be energy demand, or who knows. But you can't just buy some random rink-a-dink $1 billion stock that no one gives a fuck about. Like, that's not convexity outlier. You're buying dips in very strong trending names, right? Like Nebius was, I think, did Nebius bottom in March 30th? Right here, this is March 30th. It went from 91 to 275. That's a convexity trade. right? And maybe it was 420. 402 is when a lot of the names really started to move. Oh, it's April. Thursday. There we go. So this is when a lot of the names started to move. Like this went way up here. But look, there's no delta spread. There is a gamma spread. That's interesting. There is a gamma spread. But on delta, look, it's all calls. It's just dominated by all calls. You see that? And that's what you're looking for on elevated volatility, because when volatility compresses and stocks start to lift, this is all buying demand from the dealer. That's what you're looking for, especially when you have like deep in the money largest calls. Like these ones are just a driver of consistent buying. Oh wait, like look how long it's been there. It's just consistent driver of buying. Especially if you have this largest put that's sitting way up here, that also helps drive a lot of buying if the market starts to rally and volatility compresses. But I want to run it on here and see if like Nebius shows up on 420. Nope. So maybe I need to do some work there. Western Digital showed up. Look at that. Look at that delta spread. I definitely wouldn't be trading. So, let me mention something else. The back test of the spread trades never worked to the downside. Meaning that if you're trying to trade a put spread to the downside, that never worked. What actually happened is that the market bounced on the top part of the spread. It was support and it just continued to rally. So do not trade to the downside. Now my back test only goes back 2 years, which has been a bull market. So maybe it changes in regimes that are bear markets. And when I get more data, I'll test that. But please do not trade the spread trades to the downside. They have like a 15% chance of winning. So just avoid those. Okay. But look, Western Digital happened. So this trade would have told you to buy a 120 plus DTE, which is like this September. It would have told you to buy a 15 delta, which you don't have, so you would have bought this 470. That sounds a bit crazy. I don't even know if that's going to work. But let's see what happens. Did we go to 470? We went to 570. We went to 570. Okay. So it'd be interesting to put the date on here, but 570 you would have made, and it was June 6th. It's a Saturday. I'll put it at the 5th. 570, 637%. That's not bad, right? And what was that? April, May, June, in 3 months, right? So those type of trades are what you look for, but they're fixed. So it would have been like $500 or something. That's the trade you would have put on. So whatever, 600, 3 grand, right? In one trade in 3 months. That's a right tail distribution. But anyway, I think that's all I got for now. STX was one, Seagate. Look, see? It's actually showing some really strong signs here. So if we go back, it was April 2nd, right? Here. And obviously you're going to get a breakout. And so you see the spread here, like that, you just avoid those things. Those are just drivers of upside movement. That's all those are. And you have deep in the money calls here. Okay, so what is this one? Chain 1. Okay, September. This has a 25 delta at 680. Did we even go to 680? Wow, that's great. It's so crazy. Like, why would you buy that? It sounds so stupid. But we went to 900. That's crazy. What the hell return is that? Um, these convexity trades are so dumb. Oh, and you could zoom now with this. There's no button. It was it went to 900. Did I say? What did I say? What did it go to? 950, 960. Wow. 1,387%. That's crazy. So those convexities, when volatility is elevated and you're playing things that are theme based, right? So, so $500 would have been $6,850 in 3 months. So that's those are tail trades. And remember, you don't want to buy bullshit. You're not trying to buy some freaking, you're not trying to buy Airbnb. You're trying to be on theme. You're trying to buy the new hot shit. You're trying to pile into the hype and the mania when you get those opportunities. But I'm pretty sure that at some point, those convexity style trades with the theme and the manias are just going to lose. And that's why you have to have a fixed trade there, if depending on your portfolio size, right? So that's a 2% on the portfolio if you have 25 grand, right? So just be very, very cautious about trading those large convexity trades. They're very gambly. They're very edge case. They're high convexity, high return profile, but you're gonna have a lot of losers. 85% will be losers. So you got to be very, very cautious about what you buy with those things. I mean, even just looking at the chain and looking at that 25 delta, and you're like, man, it has to double in 100 days. That's crazy, right? You don't really, it's a non-human trade. It doesn't make sense, basically. But hey, sometimes it works. Okay, that's all I got. So, recap, watch your gamma pins on VIX here. Make sure that if you're trading below it, I'm going to go back a day here. Look, 16.25. If you're down here, you have to expect that you're going to get some volatility in the market. And when you get volatility in the market, things get smacked, right? Not all of them, but things get smacked. And what you're trying to do is place trades up here, longer term trades up here. You're not trying to, you could probably trade short term. And when I say short term, I'm talking 3 months, but some people trade daily, which is really dumb. Don't do that. It's just gambling. Okay, that's all I got. And I'll see you guys on the other side. And if we get any more market information or news, I'll come back and make another video. Good luck out there, and be patient.